Today I'm going to explain the stock market in a way that will make you say, why didn't I learn this years ago? Because most people see the stock market completely wrong. They see it as a high-speed money machine or a complicated battlefield where only experts survive. But the truth is, the stock market is far more simple, far more logical, and far more connected to our daily lives than anyone tells you. Let's start with the first mistake almost every beginner makes: thinking the stock market is a place where people magically turn $100 into $10,000 overnight. Movies and social media love showing dramatic success stories. Someone buys a random stock, wakes up rich the next day, and suddenly becomes a financial genius. But real investing? It doesn't work like that. If anything, beginners who chase these miracle gains often lose money faster than they imagined. The stock market isn't a casino, it's a tool. And when you treat it like a tool, patiently, consistently, thoughtfully, your money can start working even when you're asleep. Yes, literally while you sleep. Let's begin with the foundation: what a stock actually is. A stock isn't just a symbol on a screen or a random number moving up and down. A stock is a tiny piece of ownership in a real company. When you own shares of Apple, you literally own a slice of Apple. When the company grows, earns more money, expands into new markets, develops new products, and becomes more valuable, your ownership becomes more valuable. That's why long-term investors care about companies, not just charts. Because behind every stock, there is a real business run by real people making real decisions. Now, stock prices move every second, and this can look chaotic to beginners. But there are only a few simple reasons why prices move. One reason is supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price drops. Another reason is company news. Earnings reports, partnerships, new products, or scandals can all move the price. And finally, there's market psychology, fear and greed. Sometimes prices move simply because people panic, or because they get too optimistic. Understanding these movements doesn't mean you need to predict them. Predicting short-term price movements is nearly impossible, even for professionals. But understanding why prices move helps you avoid emotional decisions. If you see your stock drop by 3% in a day, it might not mean anything serious. Prices wiggle all the time. What matters is the long-term direction. Now let's talk about a scary word: risk. Every beginner fears losing money. And that fear is valid. You can lose money in the stock market if you invest blindly, chase hype, or panic sell when things go down. But risk is not a monster you should run from. Risk is something you manage. You control it by learning, by diversifying, by investing gradually, and by avoiding emotional decisions. The easiest way to manage risk? Don't put all your money into one stock. Beginners often say, but this one looks so promising. Sure, but even promising companies can crash. By spreading your investments across many companies, sectors, and even countries, you avoid the disaster of losing everything because one stock failed. Another way beginners reduce risk is by using index funds. Investments that automatically include hundreds or thousands of companies at once. With one purchase, you're instantly diversified. Many long-term investors start here because it's simple and stable. Index funds don't try to beat the market, they are the market. But let's go back to something important: emotions. If you talk to almost any beginner who lost money, they'll tell you the same thing: I got emotional. They got excited when prices went up. They got scared when prices went down. Emotions are normal, but investing based on emotions is dangerous. You need rules, a system, a plan. Let's explore the concepts beginners hear but don't fully understand. Terms like bull market, bear market, volatility, market cap, dividends, and P/E ratio. These sound complicated, but let's simplify them. A bull market means prices are going up for a long time. Investors feel confident. A bear market means the opposite. Prices are falling and people are fearful. Volatility means how much prices move. High volatility means big swings. Low volatility means calm. Market cap tells you how big a company is. Small companies can grow faster but are riskier, while huge companies like Apple and Microsoft grow more slowly but are more stable. Dividends are payments some companies give shareholders, like sharing profits. And P/E ratio tells you whether a stock is cheap or expensive compared to its earnings. You don't need to memorize these. You just need to understand them well enough so nothing feels intimidating. But now comes the part that truly separates successful investors from frustrated beginners: patience. Patience sounds boring, but it's the most powerful weapon in investing. When you give your investments time, years, not days, something magical happens: compounding. This is when your gains start earning their own gains. It's like planting a tree. At first, growth is slow. almost invisible. But as roots strengthen, growth accelerates. Compounding works the same way with money. A small amount consistently invested can grow into something huge over time. Let me tell you a real example of someone I spoke to years ago. She was in her 20s, scared of investing, convinced she needed thousands of dollars to start. But I told her, start with $50 a month. She didn't believe it would make a difference, but she did it anyway. 5 years later, she sent me a message, "I can't believe how much it's grown." Not because she made lucky choices, but because she was consistent. No hype, no panic. Just small steps repeated over time. That's why beginners should start small. Starting small protects you from emotional decisions because you're not risking a huge amount. You're able to learn, observe, and get comfortable. Now let's talk about something beginners always ask. When is the best time to buy? The truth is, nobody can perfectly time the market. Trying to buy at the lowest point and sell at the highest is impossible. The better approach is this: buy consistently at regular intervals regardless of market conditions. This method is called dollar cost averaging. It helps smooth out volatility and removes stress from the decision-making process. Another common question beginners ask is, how do I pick stocks? And here's the truth: picking individual stocks requires research. Real research. That means looking at what the company does, how it makes money, its competitive advantage, its financial health, and its future potential. But if this feels overwhelming, that's normal. You don't have to pick individual stocks. Many successful investors simply invest in broad index funds and let the market grow over time. But let's say you do want to pick stocks. Here are simple guidelines. Invest in companies you understand, companies with strong track records, leaders in their industry, companies with healthy earnings, and businesses that solve real problems. Avoid penny stocks, hype-driven stocks, and companies you've never heard of before yesterday. If the company doesn't have a real business model, it's not investing, it's gambling. Another trap beginners fall into is checking their portfolio too often. When you check daily, you see all the little ups and downs. These tiny movements create stress, anxiety, fear, exactly the emotions that lead to bad decisions. A simple rule: check once a month. That's it. Let your money work quietly. Don't disturb it. But maybe the most important mindset shift you need is this: understand that investing is not about getting rich quickly. It's about getting rich slowly and staying rich. Wealth built slowly tends to last. Wealth gained quickly often disappears quickly. Now let's talk about a part of the stock market that beginners absolutely must understand: market crashes. Every few years the market drops. Sometimes a little, sometimes a lot. Beginners panic. But experienced investors see crashes as opportunities. Think of it like a massive sale on your favorite products. Would you panic if your favorite shoes dropped from $200 to $120? No, you'd be excited. The same logic applies to stocks. During market crashes, great companies become cheaper. If you're investing for the long term, dips aren't threats, they're gifts. But here's the key: only people with patience benefit from crashes. People who panic sell lose. People who stay invested or even buy more win. Let's also talk about brokers, the platforms where you buy and sell investments. Beginners should choose simple, low-cost brokers with good educational tools and intuitive interfaces. You don't need advanced trading features. You're not trying to become a day trader. You're building wealth slowly and calmly. And speaking of day trading, beginners often think they can profit from quick trades. But day trading is incredibly difficult, stressful, and statistically unprofitable for most people. It's not investing. It's speculation. If your goal is long-term financial growth, avoid day trading. It drains your energy, your money, and your mental health. Instead, do this: focus on building a long-term investment plan. Set clear goals. Decide how much you can invest monthly. Pick broad index funds or stable companies. Stay consistent. Reinvest your dividends. Avoid emotional decisions. And give your investments time to grow. Let's talk about mistakes, because beginners will make mistakes. You'll buy a stock that goes down. You'll sell too early. You'll hold too long. You'll get excited. You'll get scared. Mistakes are not failures. They are tuition fees. Think of them as part of your education. What matters is that you learn from them. Now, one more thing beginners must understand: the stock market rewards discipline, not intelligence. You don't need to understand everything. You don't need to predict anything. You only need to follow simple rules consistently. And consistency is more powerful than perfection. If you're still worried about starting, let me simplify everything into one final idea. Investing is like planting a seed. If you wait for the perfect day to plant it, you'll never plant it. But if you plant it now, water it regularly and give it sunlight and time, it will grow, whether you check it every day or not. So take the first step. Not a big step. Just a step. That's all you need to begin your journey.